I'll touch upon the learning agents from historical data, and then finally model agents using reinforcement learning with specific emphasis of modeling subrational human investors. So this is all joint work with various members of a big AI research team. We have a fairly large team, as you might have heard. We have about 100 researchers that are working on not necessarily market problem, and maybe about 10 of those who work on market, on trading specifically. And so you'll see their papers featured throughout my talk. So would love for you to take a look at that, but please don't hesitate to contact if you have any questions. All right, so why market simulation, right? Why would anybody want to simulate the market? It's very common, as you might all know, to test trading strategies in a simulated environment prior to rolling them out. Also, since reinforcement learning is becoming extremely popular and it's proving its value in the real world, as you might have heard from the previous talks, training agents in a simulated environment is also value. Simulated environment is also good for various what-if scenarios, right? So for instance, you have your trading strategy designed and you just want to test it, sort of crash test it in various counterfactual scenarios. Like, how is my strategy going to behave if momentum agents do this and that? How is my trading strategy going to behave in extreme volatility, in low volatility, in market shocks, in flash crashes, and so on? So something for which you might not necessarily have historical data or sufficient amounts of historical data. You can simulate this kind of scenarios. And finally, an interesting and, in my opinion, potentially very large application is market mechanism design, right? So what if markets function differently from what they function now? And there are some examples in the literature that I'll be mentioning, but yeah, this is where a simulated environment comes really handy as well. And depending on where you are in modeling what exactly you want to do, you will probably want to approach modeling your trading agents differently. So this is what I'm going to talk about. So with regard to what is being done in industry right now, the industry convention for simulation is still market replay. So what is market replay? Market replay is essentially historical backtest that everybody is familiar with, right? So you're just replaying your strategy against historical data, as opposed to agent-based simulation, which is sort of the bottom-up approach to how similar to how the actual markets function, right? So you model the market on an agent level, and then market data sort of arises from the agent interaction. So as you all know, I'm sure, an important difference between a historical market replay and agent-based approach is that historical market replay essentially does not let you simulate market impact. So market impact is an effect that your trading agent that you're developing has on market, right? And when you are interacting with historical data, you essentially have no way of demonstrating something new, right? Because it's all, your experimental agent was not in history, but is an agent-based simulation. Your experimental agent is placing orders to the exchange. Other agents interactively observe your presence, right? And they are able to respond to your agent presence. So what happens, for instance, in case of algorithmic execution? So the gray shaded area on both charts is period of time when an algorithmic execution agent was present. As you see in historical market replay, depending on implementation. So on the x-axis you see time, Shaded arrays when the algorithmic execution agent was present. You can think about TWAP strategy. Y-axis is deviation from historical price. So you just see this little spike. This corresponds to peeling layers of the limit order book. It depends on the historical backtest implementation, but essentially, this is not a consistent market impact curve. With agent-based simulation, if agent-based agents are calibrated well, you can observe the curve that is similar to this classic market impact, right? You see price increase when the algorithmic execution agent is present, and then price decrease that corresponds to market reversion, which is along the lines what happens in real markets typically. All right, so how do we get there, right? At JP Morgan AI Research, we've developed a multi-agent simulated environment that you might have heard about. It's called Abides. We published a number of papers using this environment, and we've recently open sourced it. So the non-proprietary configs and agents are available for everybody to use. We would like for you to use it and let us know how it goes. We would like to learn your feedback. What is Abides like? For those who don't know, it's a NASDAQ-like exchange agent that maintains a limit order book. So you can place orders at nanosecond resolutions. They are the current, we only have FIFO order matching implemented right now, but you can easily adjust to other order matching rules. You will have a basic selection of market agents that you can use. So for instance, we have momentum traders, market makers, value traders, nose traders, some basic reinforcement learning agents that you can give a try. And essentially what you can do, you can compose your own simulated world of agents, right? So you could say, well, my simulated world consists of 2 market makers and 100 momentum agents and 1,000 value traders. And then you train your strategy against this simulated world and see what happens, right? For reinforcement learning specifically, we have a GIM, OpenAI-like GIM wraparound on Abides. So this is something that interface that allows you to interact, it allows your learning agent to interact with the market environment, multi-agent market environment, without actually in such a way that you don't necessarily need to know the underliers of the market configuration, right? And it's a standard GIM interface. You can use RLLib to train various reinforcement learning agents against the bias configuration and so on. So again, it's fully open sourced and available online for people to try out. All right, so applications to trading. As you may imagine, P&L improvement, right? So you want your strategy not to lose money or to make more money. Explainability, so this controlled experiments and what-if scenarios allow for, yes, please. Yes.
Tarun?
Yeah, so it sounds very interesting, and I totally see how it relates to this scenario analysis or the worst case analysis. Could you talk a little bit about how one could try and use it to simulate in a forward-looking sense? I could put 100 momentum traders, 50 value traders, but that's just my own thinking. How do I connect it with what do I think is likely to happen? Otherwise, it's pretty much like I think what tomorrow is going to be like, and I use.
So by forward-looking sense, you mean essentially solving a prediction problem. Is that,
yep.
Did I understand you correctly? Okay,
yes.
So that's precisely what I'm going to talk about next. This is an excellent question. Generally speaking, it's very difficult to use it for prediction problems. There is a group of problems, particularly market mechanism designs, for which the available version of Abides is extremely useful, and I hope I'll convince you in that. For solving prediction problems, however, it's extremely difficult because it's very difficult to calibrate true multi-agent simulation to the market data, right? And I'll speak about the specific difficulties that we're facing. So please bear with me here. Thank you for the question.
Thank you.
Yeah. Suppose you have a perfectly or sufficiently well-calibrated simulation, right? I hope you believe me that it allows for controlled experiment design, right? An additional explainability of what actually happens. And it also allows you to crash test your strategies. All right, so market mechanism design, right? So you can say, well, what is going to happen to my strategy in a market that does not exist right now? So what if, for instance, exchange fee schedule is different from what it is? And what if the exchange tick size is different from what it is? And indeed, one of the most famous literature example, so that was an experiment conducted in 2007, was experimenting with introducing new NASDAQ tick size. Essentially, multi-agent simulation was used in order to demonstrate whether new tick size will allow proliferation of manipulative strategies. Our team has recently done work on equitable market mechanism design, which essentially simulated a market that does not exist now, that instead of providing flat exchange fee schedule, provided dynamic fee schedule learned using reinforcement learning. And we were able to demonstrate that this kind of schedule allows for the markets to be profitable to participants and also allows for the markets to be more equitable. Well, how to design trading agents depends on the application, as we just said. So we'll go over all these three approaches one by one, and we'll kind of opine as to what kind of approach is appropriate in what cases. So rule-based agents are simple background agents. As somebody just pointed out online, extremely hard to calibrate to realism. Why? Well, imagine you design a very basic market maker, right? So an agent that just places orders on both sides of the limit order book to satisfy a regulatory constraint. You probably don't know a proprietary strategy of that market maker, right? And additionally, public data that is available is such that ID data is not there, right? So we have no way of inferring this kind of data easily. There is some work that tries to do clustering. However, this is still in very, very early stages, and it's difficult to say whether it's possible at all. However, rule-based agents are still useful to model certain stylized properties of the market, right? So for instance, you are working on a market mechanism design problem, you implement some rules-based agents, then you would check for some stylized facts to be satisfied. And we still believe that this kind of configurations are appropriate for studying structural properties of the market, right? Not for solving prediction problems. We cannot say if strategy is going to make $100 or lose $100 using this kind of approach. However, we are able to say make more general statements about how markets would evolve. So we believe that market mechanism design with rule-based agents is possible. About a bias rules-based agent, we have a library of very simple rule-based agents available in Abide. So noise agent that mimic retail agents, just arrive to the market randomly, trend on demand. They're not the sophisticated kind of knowledgeable rule-based agents, really basic ones. Value agents that trade on the knowledge of fundamental, momentum agents, market makers, and so on. So please take a look. And here I would like to give an illustration of the same chart that I demonstrated to you before. So the classic market impact curve, and I'd like to tell you how we obtain this classic market impact curve using classic market impact curve dynamics to be accurate, right? So the dynamics of market impact that one would expect using the multi-agent configuration. So we have in the gray area execution agent trading by lifting limit order book layers in one direction. So for instance, it's buying. Momentum agents are amplifying the impact of execution. When execution is finished and the momentum of trading is gone, value agents push price back to the fundamental. So by doing that, very, very simple configuration like that, we're still able to replicate the structural properties of market impact. So it's difficult to calibrate it to the precise level, to the precise number of basis points that the market moves. But if just the price move and subsequent price reversion is of interest, you can do this in multi-agent simulation very easily, as opposed to historical market replay, right, where it's not an option. Okay, so for trading applications, as we all know, a very high degree of market realism is needed, so dollar amounts matter. So we want to ideally learn a responsive and realistic simulator from historical data. So right now, people mostly use historical backtest, right? So they use it along with some assumptions on no market impact for trading applications. So they say, well, the order size is sufficient, that the agent is placing at a time is sufficiently small, and the agent actions have to be spaced out in time, right, to allow for historical order book replenishment. We want to see if we can do better. So we want to see if we can learn a realistic and responsive simulator. So ideally, we want to be able to learn market impact. So how are we going to do it, right? So the big challenge that is not possible to solve with current state of public data is how to discover and emulate individual agent behaviors, right? So we see order book data essentially as a time series, and there is no way for us to tell who did what in the limit order book, right? So there is no way for us to come up with this mapping of simulated agents to real agents. That would be ideal, but we cannot do that as of now. So for those who don't know, this is sort of how the limit order book data looks like, right? So you just see the timestamps, certain actions that happened in the market. So you essentially view it as a time series. Again, no IDs, right? So in reality, you don't know who placed which order. So any kind of inference of strategy is not possible due to that. So what we propose to do, by the way, there is some work that, including the work that is done in our team, that is trying to work out methods to infer agent identities from the market, but this work is in very, very early stages. Hopefully we'll get there in a more confident way, but we're not there yet. What we propose to do is to learn the world agent from the market, right? So instead of really separating, learning the multi-agent simulation, through multi-agent simulation, learn the world agent that's like connects the joint interaction of the market together in such a way that this world agent is responsive. What are we after? Realism and responsiveness. How are we proposing to do it? We're proposing to do it using conditional generative adversarial network. Why GANs? Well, there are no assumptions on underlying data. We are able to learn multimodal and complex distributions. If done well, I'm not saying that GANs are easy to train. GANs are notoriously difficult to train, particularly with noisy data. However, if done well, you are able to achieve high degree of realism. And also the fact that we're using a conditional GAN, not a regular GAN, allows you to condition on certain market features and as a result, provide responsiveness. So we're able to achieve responsive market simulation. So we can, distribution-wise, when we assess stylized facts, we believe we can get them pretty well. So here is the depth or order volume distribution per depth level, charts for different stocks. So you see that we're able to differentiate between stocks with different distributions, and market impact phenomenon is also picked up, right? So this way of approaching training is responsive and realistic. So if you are interested, this is the paper where we're introducing the simulator. Again, any feedback is welcome. All right, and here I would like to just throw some work in progress, right? So our attempts to model sub-rational behavior. We've presented this work recently at an iCave workshop. However, it's something that we are working on, and we would like to study this particular problem more. Again, the problem not very commonly studied in the literature. So as you all know, reinforcement learning is learned to obtain different trading strategy, right? So you can formulate MDP in differently. And for instance, you can learn a market maker to provide liquidity to the market. You can learn an execution agent to minimize cost of trading. So the framework of reinforcement learning is such that agents are trained to maximize rewards, right? So by definition, you're learning an optimal strategy per your MDP definition, right? You are learning an optimal strategy. So it is good for modeling electronic trading agents, right? So for instance, if you are to model an electronic trading agent, yes, it's a reasonable assumption that that agent is going to always act more optimally. However, how would one model a human trader? As we all know, humans come with humans are more complex, right? So they come with their idiosyncrasies, psychological biases. Humans need to make satisfactory rather than optimal decisions. So optimal decision making is not always possible for humans. An interesting way to handle this that we've recently discovered in the paper, so it's a paper by Chan and Dragan, Human Rationality, both bad and good for reward inference, is to essentially approach modeling sub-rational. We don't call them irrational, we call them sub-rational traders, so sub-rational to human traders as reinforcement learning agents. So Bellman equation gives a solution to optimal decision making, right? And we speculate that it can also give insights about suboptimal decision making, right? So if you look into components of different components of Bellman equation, these different parameters correspond to different ways that a human can be irrational, if you think about it. So for instance, something that is called prospect bias in the Chan-Dragan paper is essentially risk aversion property, right? So some humans like to maximize positive rewards, some humans focus on avoiding negative rewards, although here one would speculate that that could be a property of electronic traders as well. Also, something that humans definitely do, they tend to overestimate their ability to control random events. And again, by looking at the transition probability matrix and modeling it accordingly, you can introduce this overconfidence bias into the learning problem. Something that we focused onto first, so the myopic behavior. So people only care about near-term rewards as opposed to long-term rewards. At least some people only do that, and it's natural for a human to do so. So if you are to learn a fully rational electronic agent, you'll probably put very high parameter gamma here in the training as a training hyperparameter. For sub-rational agents, we experimented with lower parameters gamma, and we were able to demonstrate that when you are training an investor agent, yes, please.
Why would you say gamma is equal to 0.1 sub-rational? Why is that guy also not rational?
Well, it's you're
greedy, but
yeah, but you're essentially discounting the long-term rewards very strongly, right? So I'll show you by the example. So yeah, so very high gamma means that you're looking into very long-term rewards, right? The lower your gamma is, the less you care about long-term rewards, right? Discounting becomes very, very heavy, and it's becoming very obvious that it's heavy to the point you really care about very few number of steps ahead, as opposed to true solution by decision by reinforcement learning when you optimize against the infinite horizon. Thank you for the question. So we are, in this example, we are learning an RL investor agent. So an agent that just maximizes its profits by buying or selling. And we are able to demonstrate essentially that for lower gammas, you see agents that, for instance, in this kind of scenario, when the market is drastically dropping, just selling as opposed to buying for electronic investors, because electronic investor has seen such scenarios before and it anticipates that the market is going to go up. So various examples have demonstrated that electronic traders tend to be more profitable when they are modeled with high parameters of gamma. Boltzmann rationality, so it's essentially a fact, refers to the argmax in the Boltzmann equation, right? So instead of agent being able to compute argmax, it's approximating argmax by Boltzmann softmax. So if argmax is approximated that way for beta infinite, you get a more rational agent. For beta equals 0, you essentially take random action, and human agents would go with the value of beta somewhere in between. So again, we demonstrated superiority of electronic agents that are modeled with high values of beta as opposed to human investors done like that. And an interesting thing that we discovered, something that we did not expect, but if you think about it, it makes sense, that electronic investors are more confident and they tend to place orders deep in the limit order book. So by doing that, they're able to make better decisions, right? And as a result, they're able to make more money than human agents. So I think we are out of time. But please let me know if you have any questions. Happy to chat after the talk, and thank you for your attention.